Good afternoon, everybody. This is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments for Friday, October 10th, 2025. Well, 10-10-25. What a day and what a week. I'm going to dig into the numbers right here, right now, so hold on tight. Lots to talk about. This morning, um, some comments from President Trump that they were going to cancel the meeting in Korea. He made a lengthy post on on his Truth Social, and again, just to recap it, at the end of the day, um, it's a negative, negative, negative. Now this is coming after we made all-time highs yesterday in the stock market, so everything's relative. Um, we'll see where we are 2 or 3 weeks from now, but certainly today surprised a lot of people. It took a lot of steam off of the bullish ideas that we were going to be getting a definite 13 or 14 billion dollar program coming out here because once again the government remains closed. We have no data, so we are left to trade tweets. And this is what happens when you've got algorithms and nervous people and heading into a long weekend. All kind of movement today. Lots of stuff to talk about. Crude oil down 266 as I'm talking to you, trading 58.85 on concerns that now that there's a peace agreement in the Mid East, that oil flow is just gonna, the spigots are gonna go, and we're gonna be very, very well supplied. We still have not taken out where we were back in April, down at 55. But certainly, it's good news, bad news. At lower days in the commodities, but it all has to be taken with a grain of salt. Yes, it's a down day, but I want to do the math real quick. Let's start off with the S&P 500. Since April, we rallied 40%, 40%. So sooner or later, we were due for a pullback. Okay, kids, but nothing goes up forever and ever. So part of this is natural. Part of it is mm, people seize on any opportunity to try and get people emotional. And again, now if you're short, you're going to be talking your position. The stock market up 33%, I believe, since the April low. So to have a pullback is not unusual. I posted the 10% and 20% corrections that we would have if we came off of our all-time highs. It's not unusual. Again, can't say that enough. The stock market's up 40% since April, and the S&P and the Dow Jones was up over 30% the same time frame. So we're well overdue for some sort of a correction. All right, let's get into the corn and wheat and beans. Corn down 5.25 cents today, settled at 413 even. However, for the week, down 6 cents. November beans down 15.5 cents, settled at 10.06 and 3/4. One as low as 10.02 and a half. We did not take out $10. We'll see what happens next week. Again, most of that is coming off of the president's China tweets, and you can dig into that all you want. I'm not going to get into that right now. There's enough information out there like that. But basically, soybeans did not like that, and now we're in risk. Are we going to go back and test the lows at 993, which we had on the last USDA report that was posted? Anything's possible. We had just had a really good battle for 6 or 7 days at that 20-day moving average. If you've been reading my letter, I was harping on that thing, probably in an obnoxious way. You had the decent corn at the 20-day moving average right around 423, couldn't get through it. You had November beans trading at 1023, which was right there at the 20-day moving average. It was also the midpoint of the entire year's trading range for soybeans. And there's been a lot of squawking going on and forth about the reasons soybeans are lower. A big part of it is the fact that South America sold China 4 billion bushels of corn. Generally, China buys a billion bushels from us. But over the last 15, 20 years, South America has been planting more and more beans, and it's come home to roost. China always, for a long, long time, didn't want to be in a situation when they were over a barrel, literally, to buy our soybeans. So that's something that's going to have to get worked out here in the next 6 months. That's going to be a big part of the new trade agreement, assuming we get one here in the next several months between President Trump and President Xi. But for the week, November beans down 11.25 cents. Not what you wanted to see. Again, a couple of days ago we were at 10:30. People were saying, "Well, here we go. We're going to get our Chinese deal. We're going to get a check from the government. Everything's going to be all right." Mr. Market always comes back to bring us all back to reality. Put it that way. In the wheat, new contract lows. If you read the letter this morning, I let off. We had new contract lows in cotton and in wheat. December Chicago wheat finished the day down 8 cents at 498.5. We talked about what would happen if we settled below 502. Well, now we know. For the week, December Chicago wheat down almost 17 cents, down 16 and 3/4 cents. So wheat is under pressure. For clients that I work with, we did have some 530s and 520 puts on the books. We rolled all those down today where we were able to do that. We've got options that have doubled in value. When option doubles in value, we want to take money off the table because guess what? A week from now, 2 weeks from now, we come in and something's changed. All these options that we bought for 10 cents that are worth 25 or 30 cents. We don't want the 30-cent option to go worthless. We want a 4 or 5 cent option to go worthless. And what happens? How do options go worthless? Well, if it's a put option, options go worthless if we rally. So you got to manage these positions when they double or triple. You just have to. And I'm not calling a bottom. I'm not doing anything else. I'm just managing the value of these hedges. Lots of times why people say they hate options is because they have an option, they buy it for 10 cents, it's worth 30, and then 2-3 months later, when it expires, it's worthless. And like, oh, didn't do anything for me. That's a whole other conversation, which I talk about in my seminars and also in my weekly commentary, private commentary. If you're interested, sign up for that. Basically, it's a classroom type deal where I cover something in depth once a week. Let's go over to the one bright spot of the day, the protein complex. December fat cattle finished up 260, 242.52. After getting hammered early in the morning, we had cash cattle trade higher in the country. Higher cash cattle trade, which is very impressive. When you get a correction in the stock market and the cattle shakes it off, typically what happens is if they can't sell enough S&P, they'll sell fat cattle and feeder cattle. Feeder cattle finished November up $1.85, 375.90. That's a new contract high settlement. I will say this: if you look at the weekly change in fat cattle, up 8 cents. That's correct, 8 cents. 8 cents a hundredweight for fat cattle in December. How about feeder cattle? November up 20.5, over $10,000 on a 1 lot. So anybody out there, if you're using futures, to hedge your feeder cattle, that's a big margin call for you if you're short. And granted, you own the cattle, so your cattle's going up in value. But boy, it's a lot nicer, I think, in markets like this to look at rolling up puts. For example, I had some puts on with guys around 350, right? Today, if they wanted to, we could roll their 350 puts up to 360, and I think we were spending about $1.70. So for $1.70, you go 10 higher. And again, that's at your discretion. It's a lot better to be rolling puts up for $1.70 than to have been making $20 or $25 worth of margin calls if you're short futures. That's the difference between options and futures, kids, right there in a nutshell. When you have powerful bull markets like this and you're already long the field, you don't want to be capping the profits by sending in margin calls if you're short futures. Real quick, I want to touch base with the rest of the markets. Crude oil, right now, as I'm speaking to you, trading 58.84. That is, largely in response to, again, the Trump tweet, the concern that the demand is going to be lower, the concern that there's going to be a lot more crude oil coming on the markets here. Basically, we haven't been this low since June 2nd to October 2nd. That is a 4-month low. What level really matters? The 54.10, which is where we traded back in April. So yeah, we're at 58, 55 bucks, excuse me, 59 bucks. Could crude oil drop another $5? Anything's possible. We were there back in April. So yeah, that's going to also probably weigh negatively on the whole um, ethanol math problem, right? Because ethanol does better when crude oil is above $70. So it's one more thing that farmers are going to have to deal with here as we look out as 2026. Real quick, I'm going to talk about that before I go away. December 26, 2026 corn, it's at 453. November 2026 beans, we're sitting here trading at 1056, 1056. Yeah, it's time to start thinking about next year. I know it's October, and I know most people don't want to think about anything until January when that comes down the pike. But that's one of the things I do with my clients is work on that, look ahead for what works. On the flip side, if you use a lot of diesel, well, crude oil's at 4 month lows, diesel's at 4 month lows. We're at 220 on the futures. If you use a lot of diesel, I would watch that carefully. There's a silver lining to all this stuff. When prices go down like this, it does give you a chance to do something. Especially if you're going hand to mouth right now. If you're in harvest, that's a benefit because the futures price on diesel fuel dropped to 220 here. If it takes out 219, that opens up the door to where we were back in March, April, May. May, this contract traded 194. So are we going to drop another 25, 30 cents? Possibly. So if I'm using a lot of fuel right now, and if I don't have my tanks already filled up, I think you go hand to mouth. So that's about it. Lots to talk about. I will be doing the weekly wrap posted tomorrow. I spend about 4 hours and go through all these charts and really dig into it. I also will be doing the private client webinar. I'm going to do that this evening, spend about 15, 20 minutes and really dig in to what we're looking at as far as levels. And it gives me a chance to share more with you about how I make decisions, how I can help you make better hedges that make sense given where we're at price-wise. This is Chris Robinson. Thanks for listening. Give me a call, 312-638-8868. Have a great night, and we'll get back after it again on Sunday night.